Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Wednesday, May 28th, 2025. Today's episode begins with our first headline: The taco trade continues. If you've been seeing the news, you may have seen that Trump was recently asked by a reporter if he knew anything about what Wall Street is calling the taco trade, which stands for meaning Trump always chickens out. This is in reference to every time he puts on a tariff, he, is perceived as chickening out. And I've been talking about this a lot on the show, and everyone seems to be very well aware of this situation. I was just talking about this yesterday. I said how the market's eventually going to shrug off anything Trump does, but it's not true. It's still continuing. Look what happened today. We had some chip software stock sink on report of Trump ordering to halt AI chips selling to China, and the stocks are collapsing here. And then he'll cancel it and it'll pop back up. It's like, Wall Street's loving this at this point. Every time he makes something go down, you just buy it and wait a day or two, and then he'll cancel it and it pops right back up. What an easy way to make money. So it's well known, and the taco trade continues. Next headline: FOMC minutes were released today at 2 p.m. These are the details of the most previous FOMC meeting. One little interesting paragraph that this is the FOMC meeting minutes here, this document that we're looking at right here. One little sentence I wanted to share with everyone here. I'll just read it verbatim. Measures of Treasury market liquidity deteriorated immediately after the announcement of higher than expected tariffs on April 2nd and partially recovered later in the period. The deterioration in liquidity, however, was commensurate with the historical relationship between measures of market volatility and liquidity, and the Treasury market continued to function well. In other words, me and everyone else that was ringing the alarm bell saying, with this Liberation Day tariffs, the whole markets were falling apart to the point where the Treasury market seemed like it was falling apart based on the price. But according to the FOMC themselves, they were like, no, we didn't actually. This is what normally happens when markets are falling apart. We did not actually see a major disruption to the liquidity of Treasury markets. Remember, as much as people believe that yields are going to keep going up, and they can, but it is the deepest and largest market in the world is the Treasury bond market. And the point here is just to emphasize, hey, they saw everybody raising the alarm bells and saying, hey, is the United States about to become, illiquid here? Is no one going to buy the debt anymore? And no, they're basically saying in this statement, calm down, everybody. That's just a little tidbit from the FOMC minutes that I wanted to share. All in all, for the most part, nothing really rocked markets very much coming from the FOMC. They're just pretty much, in a nutshell, saying the same things that they've been saying, which is they kind of see potential higher inflation, a spike of inflation. They're not sure, how that's going to balance with the labor market. If people start losing their jobs, they see in the future people losing their jobs, just like I do. And they're like, okay, combine that with prices going up, what are we going to do? And it's going to be a decision like, are we still fighting inflation, or are we going to be supporting the labor market? Jerome Powell himself, if you've watched many of his conferences, he has said explicitly that you can't have stability in employment if you have unstable prices. So with me and my crystal ball and all, I may be one of few people saying this and seeing this, but I do think that the stability of prices is going to prioritize at this juncture, largely because we went through a period of pretty, high inflation before going down, and we're still not back down to the target. That's like the bigger concern. We can't have one of these 1970s eras where the Federal Reserve loses its credibility like it did in the 1970s. That's the last thing. That's the last thing that Powell wants to have tied to his name, is the guy that, you know, lost the credibility of the Federal Reserve. That's not. I don't think he's going to let that happen. But, that's just me and my crystal ball. We had Nvidia earnings come out after the bell today. And as of the recording of this video, it is up 4.4%. This is on news of their cloud computing, so using your computer to use the power of their computers to have them do the heavy lifting for you. That apparently increased by about 73%, so a lot of business, a lot of money still going into Nvidia. It is a part of the business, I'll admit, that I sometimes ignore. And I always talk about the production of semi-chips and how we don't need an infinite amount of semiconductors. And I still think that's true. And, with the cloud computing, it's a similar thing, though. You can only build so many railroads before people realize, hey, maybe we don't need all of these railroads. We only need, this railroad and this railroad. So, I've said it before and I'll keep saying it again. Whenever you have a lot of growth priced into any stock, and especially when you have a stock like this representing such an enormous part of the stock market, we are playing with fire here. And it's only a matter of time before, we realize we don't need as many railroads as we're going to produce. I mean, there's going to become more and more competition in this space. Whenever there's money to be made, you'll have venture capital, you'll have businesses trying to get a piece of the pie until there's, enough supply that they have to compete with their prices, and then some will drop out because they're like, oh, we're not really making as much money as we thought. And the market balances itself out. This is what's so important about understanding the security analysis and Benjamin Graham's work, is that he understands this very, very well. Pricing enormous growth into any stock is a very dangerous game. But for now, the music is playing in the semiconductor and cloud computing industry. Moving on to the community topics. What moves, if any, did you make today? Robschild sits on hands. I didn't make any moves today. Coming up, we still have continuous tariff updates on a daily, almost an hourly basis at this point. Also, federal budget updates. Apparently, Elon Musk himself, the guy that was in charge of DOGE, which was responsible for trying to cut spending to help alleviate the fiscal deficit problem. He's going at odds with Trump lately a little bit, saying, hey, why do we're trying to cut spending here, and then you come out with this bill and say you're going to, spend all of this money. He's flabbergasted by this situation. So there's a little bit of a battle there, but what matters more than all of that is what will it take for the Senate to pass the spending bill? Will we see a little bit of reduction here? I think most people at this point want there to be some fiscal responsibility. We don't want the dollar to hyperinflate, which is the fire you're playing with when nobody, is interested in trying to balance out the fiscal deficit situation. We'll see how it pans out. I'll add, besides the tariff shocks, potential price shocks contributing to inflation, if the federal budget doesn't get under control, inflation will make inflation potentially even worse. So so that's still coming up as something to really look out for. Tomorrow, Thursday, we have GDP First Revision of quarter one GDP. It came out at negative 0.3% when it was initially released, and now the market's actually expecting it to be revised down 0.1%. So we'll see that data come out at 8:30 tomorrow morning. As I talked about yesterday, we also have M2 money supply velocity coming out tomorrow. I believe this is a revision for quarter one. Every recession, this goes down. Now, this can go down without a recession, but you can't have a recession really without M2 money velocity going down. So, it's just another really important piece of the puzzle to really be paying attention to. And then, of course, jobless claims. Me and everyone else is, including the Federal Reserve themselves, by the way, is sniffing out, when's the labor market going to start cracking here? When are companies going to start looking at, including the tariffs, besides all of the other stuff that I have been talking about, even before the tariffs were even ever really thought about by anybody. When are businesses going to be looking at their balance sheets and realizing, hey, maybe we can't actually have all of these people working for us, and layoffs start going up? It hasn't started yet. So every Thursday we get a little taste to see if it is starting. When it starts at this point is the way I see it. But remember, I'm just a guy with a crystal ball. We also have Costco earnings coming out tomorrow after the close. This is another big, important company that can help guide us and tell us, how the consumer is doing in the United States. We also have later this week, Friday PCE. This is the Fed favorite inflation gauge. Thank you, as always, for watching. Subscribing, the button is right over here. You put your mouse over it, and then you click subscribe. Commenting, write comments below, especially what moves you made today. And supporting. This is the information to support the channel, also in the description. It is very much appreciated. Thank you so much. The daily reminders, no changes. Click on my website in the description to read through my explanations of these things. And no changes in the crystal ball readings or the Robschild portfolio. Onto the charts, starting with SPX, the S&P 500, dropping 0.6% today on light-ish volume. Mr. Market doesn't really know what to do from here, with Nvidia earnings coming out and being such a huge piece of the pie of the S&P 500. In after hours, we are up 0.25% right now. In general, not looking super bullish or bearish. TLT, my favorite place to be. We had a candle, let's see, we're down from close to close 0.43%, but as you can see, the entire body of this candle is within yesterday's green candle, and we tested this breakout and we stayed above it for now. Again, we want to see a close above yesterday's high of about $86.10 to confirm that TLT really is heading higher here. It's certainly not bearish anymore, is the way that I would describe it in the very short term. Copper did end up doing exactly what I thought it was going to do yesterday, going back into the fight zone. I found it very interesting on Friday for it to go up almost 4%. It looked very bullish until Tuesday, where we had it really start to look like an elevator going straight back down situation. And as I said yesterday, it looked like we're headed back straight to this fight zone. And so Dr. Copper, in my book, is back in the I don't know where to go spot. when I see this pattern, I usually see it, continue to continue the pattern that we had before, which is just flat, these little candles. I'm thinking that that's what we're going to do until Dr. Copper decides to really make a larger move to the upside or downside. The last chart of the day that I wanted to bring up was actually the U.S. Treasury's yield curve, only because I wanted to talk about really quick the 2-year versus 20 and 30-year Treasury yields. I just want to point out that the difference between these two is about one whole point, 1 percentage difference. So the 2-year currently being at 4% and the 20-year being at basically exactly 5%. So this part of the curve right now is just actually totally normal. You can get anywhere between 1% and 1.5%, and that's like a normal-ish range. I'm bringing this up only because, if we do start seeing slowdowns and maybe earlier cuts, we've been pushing out the cuts, by the way, for the past few months still, but we will eventually get to the point where the cuts will seem closer and closer. The next wave of cuts, I think, is going to be pretty aggressive when we get there, and we're not there yet. But the point of me bringing up this Treasury yield curve is that when we do get there, knowing that there's a normalization between the differential between the yield on the 2-year and 20-year suggests that, to me, that when we do start getting the cuts, the 2-year will be dropping, and along with it, it can very easily pull the 20-year. But what do I know? I'm just the guy with a crystal ball, and that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.